Good evening. Thank you very much for joining for Q1 2024 investor presentation of Hatton National Bank PLC. We are pleased to explain the numbers and some of those reasons behind to kind of justify why and how those numbers have been. Let me go through the slide deck. First, if you look at the NII, we have seen AWPLR, the prime lending has been declining significantly over the last probably say 12 months, which impacted the comparative quarter in 2023, where the AWPLR was high, recording a significantly higher interest income than the particular quarter that we are referring, that is Q1 2024. We have seen as a result of PLR coming down significantly, a 20% drop in NII. At the same time, interest expense also has seen a decline, even though the decline is less than the decline we have seen in the net interest income from the loans and advances. As a result, our major part of our loan book has been in floating rates, where those are getting repriced more frequently and more quicker than the deposits are getting repriced. So that lag effect has impacted our interest expense to be showing a less decrease than the interest earnings. So as a result, NII have seen a dip from 34 billion to 25 billion during the first quarter 2024. Moving on to fund-based income, NFI, we have seen there is a little bit of stress in NFI, especially in the areas of trade, where the similar period last year in 2023, we have seen trade, specifically trade income has the fees that the banking industry has charged on trade transactions have been significantly higher than what we can do Q1 2024. As a result, even though the impact on the volume is much less, your impact on the fees have been significant, which drove to a great extent the fee income downwards. Despite the card income has been on the growth, because we have seen increased level of transactions and volumes on the card space, especially with the tourism picking up and consumer activities are increasing in the market. That has contributed almost half of our fee income, while trade and the digital and other related income has almost contributed the balance half of fee income. Moving on the asset quality side, we continue to record better asset quality ratios in the market. If you look at the industry comparison, so we are among probably one of the best three asset quality managed banks in the industry. So our impairment has contributed significantly for this improved the reflection of asset quality in the bank. So we have seen the comparative figures with the last year, same quarter, and this year. So actual impairment that has recorded in the books have been significantly low for two reasons. One is we have seen increased level of recoveries, and number two, we have not seen that much of new advances moving into stages that require additional levels of impairment. So that culminating the effect is we are recording much less than the provisions that we have made comparative quarter last year. Also, it should be noted that last year we had, other than the impairments for the loan book, we have impairments on the financial assets, which is not there in this quarter. This also has contributed improved performance on the side of the asset quality. Moving on, if you look at the operational expenses, so this is where some of those growth trajectory has made an impact. So given our operating income has not grown as we desire, and as we have seen the a decrease in the AWPLRs impacting our interest earnings and also to a certain extent the fees. We have seen, even though expenses have not increased that significantly, we have seen in terms of ratio, it has been reflecting a notable increase from, if you look at the group level, to 53% from almost 37%, and for the bank it is going up to 41 from 26. We believe when the lag effect of deposit repricing and the loan book growth starts, so this will return to normalcy by hopefully by third quarter. We should be able to see somewhere close to what we have been maintaining right throughout, when the income streams are fairly regular and high. In terms of profitability, we have seen, even though the bottom line recorded a positive growth slightly for the group, we have seen profit before tax has been under stress slightly for the group, but for the bank, we have seen fairly notable negative growth in the PBT, maybe around close to 10%. We believe once again, with the aggressive recoveries that we are targeting on the impairment side and the gap between interest expense and the interest income getting reduced, so there will be a positive impact coming into negating that PBT impact, thereby running the better incremental levels of PBT and PAT in the next couple of quarters to come. In terms of soundness indicators at the bank level, I think given extremely high liquidity levels in the market that has been seen across, we have a very, very healthy liquid asset ratio and liquidity coverage ratio very much above the regulatory requirements that was reflected in availability of liquidity, and some of those liquidity actually has gone to investment in government securities, which would have otherwise invested in the lending to private sector. So in terms of capital, we are as it is now, we stand pretty comfortable. We have a fairly a healthy buffer of capital, both in terms of tier 1 and tier 2. This is after having impaired our ISBs to the tune of 52% with the anticipated or estimated, or should I say the projected face value haircut targeting 30% around that, together with the day one impact all taken into account. I think industry itself is in the same region of 52%, even though we don't anticipate that impairment to get utilized based on the negotiations which are not resolved yet. So we are looking forward to have a favorable results on those negotiations for the industry as a whole. So we are comfortable with the capital levels at the moment. The liquidity is very, very at a comfortable level. So we believe in terms of both, so we have a room to grow. We have been little conservative in last quarter in terms of loan growth. Now we can see the momentum being picked up, maybe late February, early March. We have seen a bit of a loan growth happening, and especially coming into the next couple of months, we have seen now aggressive loan growth actually taking place. So we are quite happy wherever that we have opportunity to grow and support the industry, we will go and grow our loan book. In terms of return on equity, so we have seen our ROA getting impacted slightly as a result of operating costs slightly increasing, even though operating income, other income recorded a slightly higher level. NII impacted from 7.6 to dropping to 4.9. Which is, as we discussed on the very first slide, the impact of interest rates coming down has created this impact. But still, we believe, given the the challenges that the bank and the banking sector has experienced, ROA which is at 1.44 and ROE almost close to 13.5 would be, fairly satisfactory, even though there is room to grow in this particular area. Just to touch on rewards and recognition that the bank has received during the particular quarter. So we have been adjudged the best retail bank in Sri Lanka for the 14th consecutive time. We are very proud to say, 14 years at a stint is a notable achievement. So then we also managed to clinched the Euromoney Award for excellence in Best Market Leader in Trade Finance and Best Services in Trade Finance. We have a fairly large trade finance franchise and a significant correspondent banking network supporting our trade finance franchise. Also, so we have won a very strategic award at the Technovation Awards 2024. A gold award for the Bank of the Year for excellence in customer convenience. Bank also awarded a couple of other awards in the same awarding ceremony. We are very concerned, and we are very focused. How do we want to take our digital strengths to the next level? I think these awards are testimony how much effort that we have put in this particular area. And also we have our the inward remittance and outward remittances department, which are part of the centralized operations department of the bank, acquired ISO 9001 2015 certification, which we are very proud of, because it's something that we have been planning for a while. So we have been able to achieve completing all the necessary requirements. So then we believe that this will help us serving our customers better in a more structured and streamlined manner. So thank you very much. This is the brief that we have set it out for you. Now we are open to take any questions if you have. I have with me my Chief Financial Officer, Ms. Anuradhi Dalage, and my Chief Strategy Officer, Ms. Priyanka Vijayaratna, to take any questions together with me if you have and if you want to raise.
Hi, Damit.
Hi, Sanjeev.
Yes. Thank you for the insightful presentation. So I have a few questions with regard to your lending. What are the sectors that you have been lending since of late, and or is it broadly still into government securities is the main interest earning asset that you're gaining income from, or is it do you have sectors that you prefer to lend, and what are the areas that sectors that you stay out of as of this time?
Thank you, Sanjeev, for that question. I think you have seen the excess liquidity and the LCR and LAR ratios as a result of we are parking part of our money in government securities. That is where, when we have scanned the market, perhaps last year, last quarter, we have seen the challenges with the impairments that, likely to come through. And we have at the moment on the balance sheet 90 billion impairment for loans and advances. So what we have done, we wanted to have a careful watch which areas that we need to go before converting and diverting our money, which has been parked in government securities, towards the lending. So we have identified since of late that there's a need to support the economic revival of the country. There is a need to support export-oriented industries. So our lending predominantly, we have been evaluating propositions in SME segment, where we want to go and support not only new ventures, but the expansion of the ventures which have just come out of the stress after treated or navigated through moratoriums and rehabilitations programs of the bank. And also in the corporate side, if you look at our loan book, close to 50% is on large corporates and emerging corporate segments. So we have been facilitating, if you look at specific segments, manufacturing, exports, healthcare, education, those are the kind of segments that we have focused and we have facilitated. And of course, the trade. So we have been, maybe for the last 2.5 months, we have been very aggressive in supporting trade both ways, imports and exports, because we have seen there is a need to pick up some of those activities. Not only consumables, but there are a lot of raw materials we have seen getting into the trade cycle, some of those manufacturing facilities that require those imports and those trade related activities to flourish. And also you have asked the questions, what are the segments that we have avoided? So we have been in the watch maybe for the last 12 to 18 months on the hospitality sector. We have opened up a little bit over the last 2.5 months to support, facilitate some of the transactions, refurbishments, because we see there is the growth momentum is likely to continue. We are optimistic that cycle will support complete resurrection of the tourism industry. So then we supported incremental growth. So that is one area that we slowly coming in and we are supporting. And number two, we were very cautious on construction. We haven't seen any of the major projects are taking off the ground. Not only public but also private projects have not seen light of the day last maybe 12 to 18 months. But since of late, we have seen a little bit of activities that are taking place, and some of those are moving. So we will slowly look at, maybe we need to watch little for a little while, but we don't hesitate facilitating some of those transaction if there is a viability and continuous cash flows that we can assess. So those are the basically lending perceptions. Also, we need to touch base on the retail side. We have seen leasing market moving very aggressively through second-hand market, though there are no vehicle imports. There are signs and conversations about lifting the vehicle bans to a certain extent, might take place, might not take place during the year. Nevertheless, market is still active. We have grown significantly in the leasing market. We have seen dull demand for housing, but since of late, we have seen bit of a moment in apartment sales and other housing property sales. Cards, obviously it is increased. We see a lot of spend happening in cards, but personal loans and unsecured consumption related lending, we are also cautious as the disposable income has not reached the level that we can be comfortable to risk on an unsecured product for a consumption-based lending. So at the moment, we are trying to propel economic activities. So we will continue to do that in the next quarter as well. Hope I answered your question, Sanjeev.
Thank you, Damit. One more question. It is with regard to yesterday's monetary policy. Now, central bank has indicated the banking sector to reduce retail lending rates, especially in an environment where retail loans are not expected to pick up in second quarter according to their credit survey data. So can you give some color with regard to your retail product loan rates and how, I mean, whether it is actually feasible for a 11 or 12% market share bank like you, or what are the concerns that you have in reducing if you are against, I mean, not against it, obviously, if it is difficult, if it is challenging.
So the challenge that we have, Sanjeev, is that deposits are getting repriced with a lag. So 1 year deposits going at 8.5, even touching 9 at times. So when your treasury bills at today's auctions are dropping 8.62 and almost 9%, maybe little over 9% for 6 months, right? So it's now is within the policy rate corridor we see that arbitration opportunity that was prevalent has now been taken off. So we need to be careful in raising funds and navigating that lag effect which is coming, and where do we deploy that fund. So the margin for impairment costs, if at all, if we take a higher than necessary risk, is going to be much less. So then we will continue to watch rather than expanding into unsecured retail markets and the consumption. But at the same time, we will facilitate longer term, more stable products like housing, and maybe we can facilitate agri-related equipment, vehicles in terms of lease portfolio. So then that will propel more than anything the cash flow in the economy. So that will support a certain level of building repayment capacity. But only challenge that we would like to kind of have a watch and play kind of a scenario is unsecured personal loans. So we will facilitate when the disposable income and the repayment capacity is adequate, but we probably might not move that aggressively on that space, especially to drive consumption at this moment. So that's where we stand in terms of retail side, Sanjeeva.
Thank you very much for that clarification, Damit. Very insightful. One last question. Can you indicate the day one loss percentage that you have included in your 52% overall provision? So you indicated a 30% haircut. And given the settlement instrument provision is around 10.5, are we looking at 11.5 day one loss, or is it different in your calculations?
Sanjeev, at this moment, I think I find it very difficult to quantify it. So that depends on the prevailing rates at the time of the transaction actually happens. So our anticipation is there will be some direction and guidance, maybe in the next couple of months or so, if the elections are planned as scheduled. But the actual transaction might take few months to happen. So then that impact most likely will be based on the prevailing rates. The rate structures might change at that time based on the behaviors, right? If the credit growth picks up,
Understand.
So your environment completely changes. Your demand patterns will change. Therefore,
Got it.
I would prefer to leave it there, Sanjeeva.
Sure. With regard to your first quarter earnings, given that you have a huge FCBU operation, what were the translational losses that you incurred because of the currency appreciation?
Can I get my CFO to come in for this question?
Sure.
So it's around close to 2.5 to 3 billion translation losses were booked in terms of FCBU retained earnings.
Thank you, Anuradhi. Do you have any FIT gains also in your non-interest income this quarter?
No, there aren't any trading. Not very significant trading gains recognized.
Right. Have you done a sensitivity for every rupee? What is the amount of gain that you will have in a currency depreciation scenario?
Yeah, so it's you mean on our retained earnings, FCBU retained earnings?
That's right.
Yeah, so close to around let's say if it's 1 rupee, close to about 100 to 100, somewhere around 100 million impact we would be recognizing.
Great. Thank you very much, Anuradhi. I'm done.
Thank you, Sanjeeva. Any other questions? Please feel free to raise. Thank you. There doesn't seem to be any further query coming through, but you still can drop us a mail or any clarifications to any one of us. So we will be happy to provide any clarification that you require. Thank you very much for joining us for the Q1 2024 investor presentation. Looking forward to seeing you again with the Q2 numbers once those are published. Have a pleasant evening. Thank you so much.